This video gives an overview of the accounting for acquisitions and how it impacts financial metrics. Acquisitions arguably represent one of the most complex areas of accounting, and we could spend the entire quarter discussing its nuances. This video focuses on the most material and common aspects of acquisitions. The basic principle of accounting for acquisitions is fairly simple. You value the amount paid for the company, you value the net assets of the company, and any difference is goodwill or a bargain purchase. For example, in March of 2019, Walt Disney bought Fox Studios and various other businesses from Fox Corporation. Disney paid $35.7 billion in cash and 307 million shares of stock. The fair value of the cash is straightforward. The shares had an estimated value of $33.8 billion, so Disney paid $69.5 billion for the acquisition in total. Disney will put the 21st Century Fox assets and liabilities on its balance sheet at fair value. Disney estimated the value of the assets at $74.2 billion. This number is not from Fox's balance sheet. For example, Fox would have films on its balance sheet at what it cost to make the films, whereas Disney will value the films at fair value, the value of the future cash flows from the films. The acquirer can recognize assets for things like customer lists and in-process research that would not have been on the target's balance sheet at all. Disney estimated the value of the liabilities at $53.8 billion. This again is not the value from Fox's balance sheet, but is the estimated fair value of the liabilities. It also includes things like deferred taxes, as we saw in the video on accounting for income taxes. These estimates yield net assets of $20.4 billion, but recall that Disney paid $69.5 billion for the acquisition. We balance this out with $49.1 billion of goodwill. In the context of valuation, we can view the goodwill as the value of future residual income. The total value of the Fox acquisition was $69.5 billion. Disney valued Fox's net identifiable assets at $20.4 billion, so the $49.1 billion of goodwill can be viewed as the future economic profits or residual income. Alternatively, as stated in their 10-K, the goodwill reflects the value to Disney of increasing our global portfolio of creative assets and branded content to be monetized through our direct-to-consumer services, film, and television studio and theme parks. You may wonder what happens if the company pays less than the value of the identifiable assets. Is there badwill in this case? For example, suppose that Disney had offered Fox $18 billion to buy 21st Century Fox. Rather than recognizing the $2.4 billion credit as badwill, Disney would recognize a $2.4 billion gain on the income statement, called a gain from bargain purchase. Such deals are fairly rare though. The next topic I want to turn to is the potential to create so-called cookie jars during acquisitions. The term cookie jar refers to parking credits on the balance sheet that can be used to boost income in later periods. Acquisitions provide many opportunities to create cookie jars. For example, Disney's tax footnote shows that its valuation allowance increased by about $600 million during 2019, which Disney attributed to the acquisition of Fox. Hypothetically, a company could record an artificially high valuation allowance, which it could reduce in later years to decrease income tax expense. This would reduce the value of the acquired net assets and require an increase to goodwill to balance it out. Restructuring reserves are another example of a potential cookie jar. Restructuring reserves are not part of the purchase accounting because they pertain to post-acquisition activities, but they frequently occur in conjunction with acquisitions. For example, in conjunction with the Fox acquisition, Disney recorded $906 million in restructuring charges, which management describes as a non-recurring item. Hypothetically, Disney could have boosted the restructuring reserves by, say, $100 million, which would have created an offsetting $100 million charge to net income. Managers could explain the charge as a one-time item that should not affect estimated value by much. To see how Disney could use the cookie jar, suppose that its fiscal 2020 net income was going to be $3 billion, which translates to earnings per share of about $1.67 given Disney's 1.8 billion shares. If Disney wanted earnings per share of $2, it could reduce its tax expense by taking $500 million from the excessive valuation allowance and reduce expenses by charging $100 of them against the excessive restructuring reserve. As we can see, these changes would yield earnings per share of $2. Summarizing the cookie jars, they first require you to park a credit on the balance sheet, such as we did with the valuation allowance and the restructuring liability. The offsetting debit must go somewhere. For an adjustment to acquisition costs, the debit goes to goodwill. For an adjustment to restructuring reserves, the debit is charged against net income. We covered only 2 examples, but there are many more. For example, some forms of payment such as earnouts create an estimated liability that managers could potentially use as a cookie jar. After an acquisition, make sure to scrutinize future earnings to make sure that they reflect operating performance and not taking cookies from the cookie jar. The last topic I want to cover in this video in the context of acquisitions is comparability. Companies with acquisitions have assets and amortization expenses that are not recognized by companies that have organic growth. For example, suppose that we have 3 companies, Greenco, Blueco, and Redco. Blueco and Redco are pretty much identical to Greenco, except they're half the size. Accordingly, the 3 companies all have the same return on assets of 6.9%. These are clearly comparable, similar companies. Let's also assume that their future prospects match so that Greenco has twice the market value of Blueco and Redco. Now suppose that at the start of year 0, Blueco had acquired Redco in a stock-for-stock merger, forming a new company, PurpleCo. When writing the journal entry for the acquisition, let's assume for simplicity that the fair values of Redco's assets and liabilities are the same as the book values. Recall that Redco's market value is $900, so that Blueco needed to issue $900 worth of stock. This results in $400 of goodwill. Now we have the revised financial statements. Notice that PurpleCo has larger assets than Greenco due to the goodwill recognition. Because of this, PurpleCo shows a lower return on assets even though its operations are identical to Greenco. PurpleCo's return on assets would be lower yet if it had had amortizable intangible assets or the fair values of Redco's assets such as PP&E exceeded their book values. We can compute a comparable adjusted return on assets metric by removing the acquisition-related items from PurpleCo. Note that this gives us a 6.9% ROA number, consistent with PurpleCo being identical to Greenco aside from having grown through acquisitions. For a specific example of how acquisition-related intangibles can impact financial ratios, let's look at a set of discount retailers. The return on assets ranges from 17.4% for Big Lots to 4.3% for PriceSmart. We can see that Dollar General, Dollar Tree, and Ollie's all have a large amount of acquisition-related intangibles. After adjusting for acquisition-related intangibles, Ollie's and Big Lots swap places for the highest return on assets, with Ollie's significantly outperforming Big Lots. Dollar General's performance is much closer to that of Big Lots than in the unadjusted numbers. Five Below and PriceSmart more clearly underperform relative to their peers when we look at the adjusted ratios. This completes our overview of purchase accounting. As a next step, pick a company with a recent acquisition and familiarize yourself with the disclosures and management discussion of the transaction.